Today we're unpacking a bombshell story, the lawsuit filed against NIO, one of China's leading electric vehicle, EV manufacturers, by GIC, Singapore's sovereign wealth fund. Why is this dispute capturing global attention? It's the first time a major country's sovereign wealth fund has sued a US-listed Chinese firm. Given the historical patterns of financial misrepresentation among Chinese companies, this case, if mishandled, could trigger a disaster for the entire US-listed China stock sector. Our focus today is to investigate NIO's finances and determine if creative accounting is truly at play. First, let's establish the profile of the plaintiff, GIC. Singapore operates three major sovereign investment entities, GIC, Temasek, and the Monetary Authority of Singapore. Established in 1981, GIC, Government of Singapore Investment Corporation, is the largest of the three, ranking 6th globally by assets under management. As of September this year, GIC oversees approximately $936 billion in assets, with 51% invested in equity-based assets. Next, we turn to the defendant, China's NIO. Founded in 2014, NIO listed on the New York Stock Exchange in 2018, followed by listings in Hong Kong and Singapore in 2022. In the 7 years since its IPO, NIO has operated at a continuous loss. Its cumulative losses have reached roughly 120 billion Chinese yuan, making it the only brand among China's top emerging EV makers that has yet to achieve profitability. Why has NIO failed to turn a profit? The core issue is its excessively capital-intensive business model. NIO employs a unique strategy called Battery as a Service, or BaaS, which separates vehicle ownership from battery ownership. Typically, an EV purchase includes the battery. However, NIO tells customers, you only pay for the car body, the battery is a rental service for a monthly fee. This is highly attractive to consumers because it mitigates concerns about battery degradation and future replacement costs. The issue, however, is the significant financial strain on NIO's balance sheet. They must purchase these expensive, heavy assets up front, then collect revenue slowly via rental fees. This slow cash recovery is why financial reports consistently show losses. Moreover, batteries require constant maintenance, monitoring, and replacement. NIO operates thousands of power swap stations, maintaining a massive inventory of batteries. Essentially, the company is running an energy utility, leading to cripplingly high fixed costs. The BaaS model is fundamentally successful only if sales volume is high enough to drive scale. More battery rentals and swaps should equal greater success. The reality is that NIO's vehicles are priced at a premium, limiting user volume. Many swap stations only perform a handful of swaps daily, falling far short of the break-even point and exacerbating the financial losses. Now, why did GIC file suit? GIC acquired approximately 54.45 million of NIO's American depositary shares between August 2020 and July 2022. Given the stock's plunge from a 2021 high of $62 to just over $6 today, GIC estimates losses between $500 million and $2 billion. GIC alleges that during this crucial period, NIO manipulated its financial statements, causing GIC to be misled and resulting in poor investment decisions. Consequently, GIC filed a securities lawsuit in the US seeking compensation. The core of the dispute centers on the BaaS structure. GIC's complaint asserts that in August 2020, facing a severe liquidity crisis, NIO established Wuhan Weineng Battery Asset Co-Ltd. Alongside partners like CATL and others. GIC contends that NIO created Weineng solely as a vehicle for financial fraud. The mechanism was straightforward. NIO sold batteries to Weineng, instantly recognizing the full value as revenue on its income statement and offloading the heavy asset. This immediate revenue recognition drastically improved NIO's profit figures, while the depreciation and liabilities were shunted to Weineng. Essentially, NIO manufactured this intermediary to pull forward several years' worth of anticipated battery rental revenue onto its current books, simultaneously transferring the associated asset depreciation and debt. This process served to materially inflate its financial data. The immediate result was dramatic. NIO's fourth quarter 2020 revenue doubled, increasing from 2.85 billion to 6.64 billion Chinese yuan. GIC views this as blatant investor deception, citing 3 violations of accounting standards. 1. Improper revenue recognition. Accounting rules permit revenue recognition only when goods are transferred to a truly independent third party, and the seller no longer bears the risk. Since Weineng is an affiliated entity in which NIO is a shareholder, immediately recognizing revenue from sales to Weineng is viewed as premature recognition. 1. Concealment of liabilities. By shifting the expensive battery assets to Weineng, NIO's balance sheet appeared leaner, reducing debt and depreciation costs. However, if NIO remains responsible for battery maintenance, swapping, and recycling, the asset should not have been removed from its books. This is the definition of fictitious asset transfer. International accounting standards prohibit a company from treating an asset transfer as a sale if it retains control or continues to bear the primary risks and benefits. 1. Lack of transparent disclosure. Investors, seeing the reported rapid growth, were misled into believing the company had strong fundamentals. When growth is achieved through creative accounting rather than genuine sales and cash flow improvement, it violates U.S. securities law, which strictly prohibits misleading investors through false statements or material omissions. NIO naturally disputes these allegations. They previously faced similar accusations in June 2022 from the short seller Grizzly, which led to the pending class action suit. When the SEC inquired, NIO insisted the battery transfers to Weineng were legitimate sales, refusing to acknowledge its continued responsibility for maintenance and recycling. The central legal dispute hinges on, is Weineng truly controlled by NIO? GIC's complaint suggests the ownership structure was deliberately designed. Following a 2020 dan sur nan stent oder dan, iokudindandids a 2021 capital increase, NIO held 19.84% of Weineng, cleverly keeping it just below the 20% threshold that often triggers a presumption of control under U.S. accounting rules. Yet, financial exchanges and guarantees indicate NIO's actual economic interest is closer to 55%. Furthermore, Weineng's entire business model depends on purchasing batteries from NIO and leasing them to NIO customers. NIO sets all the price terms and dictates the types and quantities of batteries purchased. Operationally, GIC asserts that NIO's subsidiaries handle all battery monitoring, maintenance, replacement, and even the collection of monthly fees on Weineng's behalf. NIO even guarantees Weineng against customer defaults, thus assuming the core credit risk. Tellingly, Weineng's senior management are NIO employees, essentially, one team operating under two different corporate banners. In towards substantive control, locked on 55% with compliance flags. The underlying reality of this setup is not difficult to infer. Weineng appears to be a tool for financial window dressing. This is a classic example of a common Chinese corporate practice being exported to the US, where accounting standards are more stringent. While the U.S. class action suit remains unresolved and the SEC has yet to take action, the involvement of a major sovereign wealth fund like GIC elevates the issue. Even if GIC does not ultimately win, a massive investment loss necessitates public accountability, proving to its citizens that it has acted responsibly. In the end, this lawsuit, regardless of the outcome, has forced NIO back into the spotlight of a 3-year-old scandal. The damage is done. Investors, after reviewing GIC's complaint, will gain a clearer picture of NIO's actual financial health. The resulting plunge in NIO's stock is predictable, and it's not a stretch to see this impacting the entire Chinese EV sector and the US-listed China stock segment. The unfortunate frequency of accounting issues among US-listed Chinese firms has severely eroded confidence. Compounding this, the strained US-China relationship means any negative news could easily be seized upon by US officials as leverage or a pretext for further action, including the potential delisting of Chinese stocks from US exchanges. This underscores why any vulnerability in the US-listed China sector demands our immediate attention.
Thanks for watching and joining us on this journey to unveil China's many layers. If you found this video insightful, please give it a thumbs up, share it with others, and hit that subscribe button to stay updated. See you in the next video.